What kind of credit market instruments do we have? I'm just flying over these things. So on the one hand, it's very important that you've heard these, that you roughly know what they are. But on the other hand, I don't want to spend too much time on it. So here's a very important one. I talked about interest rates, but as we said up there already, there's different kind of interest rates. There's coupon rates, coupon yields, there's yield to maturity, rate of return. The yield to maturity, that's the most important interest rate. So it's important to understand what that is. Basically, when I talked about the discount rate, I mean yield to maturity. The yield to maturity is basically giving you a nominal return of any kind of financial instrument if you hold it till maturity. So if you wait till the very end and you don't sell it early on. If you have a mortgage or a car loan, the comparison interest rate is basically the yield to maturity. Now, why is that one important? Let's just imagine, for example, a car loan saying you get the car loan very cheap, 0% interest on the car loan, for example. But you have to pay the car, let's say $10,000 for the car, and on top of that, you have to pay a fee, a $2,000 deposit. Did you really get the finance for your car at 0% if they demand a $2,000 deposit on top of the car price? No, right? Because usually the car's $10,000. Now you paid $12,000. So in that case, it was even 20% more. And the comparison rate takes that one into account. So often they have advertisement 0% interest rate, comparison rate 6%. So the important one for you should be then the comparison rate. Also, when you're going for a mortgage, always look at the comparison rate. It doesn't include all the fees, but most of the fees and other things. So that's important. And in financial markets, for bonds, it's going to be the yield to maturity. Now let's play around with this one to understand what's going on. The loan here, PV is the present value. Let's say we're borrowing $100, and the cash flow in 1 year's time is 110, so we have to repay 110. So we basically look at which interest rate is matching up with 1 year, 110 future cash flow, and $100 now. And I think everybody can do that almost in their head. So $100 go from 100 to 110 within a year if the interest rate is exactly 10%, right? But you can imagine a much trickier number. So this could be, for example, 113 in 2 years' time. Then the interest rate is harder to calculate, but that's basically the yield. The yield to maturity is matching the present value with the cash flow in the future. So for coupon bonds, and now it's something that we had up there beforehand, we've got the coupon bond, which says the face value, and the coupons, right? And there's different things that we have here. So imagine, for example, if this one is yearly coupons, $1, this is the face value, $10, and we already said if you buy this bond at $10, your yearly return would be basically 10%. Makes sense, right? Because you get $1 each year, so it's 10% return. But we also said that the price of the bond can go up and down. Let's just imagine, for example, this bond is being traded at $9. Do you still earn 10%? So if you invest $9, the coupons, how much are they? Oh, number one, if you buy this bond at $9, what's the face value? 10. It's printed on the paper. The face value doesn't change with the price, right? It's printed here. The face value and the coupons don't change. So you get $10 back in, what is this here, 5 years' time, let's say. Each year you get also the coupons. They are $1 coupons. $1 compared to your $9 investment is more or less than 10% return. More. So your yield to maturity, if you keep that bond, is going to be more than 10%. That's the reason why the yield to maturity is such an important number. Who cares what the relationship is between these two numbers? You paid $9 for it. And you want to know how much return do you get on your $9. And it's going to be more than 10% in this example here, because $1 coupons is more than 10% compared to $9. And on top of that, at the very end, you don't get $9 back, but 10. the face value, right? So you've got capital gains of $1 on top too. So your yield to maturity is clearly going to be higher. Unfortunately, yield to maturities are not very easy to calculate, so I'll always give them to you. And in practice, the computer always tells you. Or often it's kind of the opposite way. So with the yield to maturity changing, the bond price changes, but we see how that happens now. Good. Yield to maturity, very, very important. How that would be calculated, and here you can see how difficult it is to calculate. If you have cash flows at different times, the yield to maturity is the interest rate that is matching up all these future cash flows and future values with a certain present value. So it's saying, okay, if you put $9 in the bank and each year you get $1, $1, $1, $1, and after 5 years you get $10 back, what is the interest rate at the bank that matches these numbers? And you can see that's not easy to calculate because it's a polynomial, so we leave all that stuff to the computer and always give it to you. But the understanding is important, that you understand it. Good. Here, coupon bond, right? So it's basically exactly the same as this one here. Now it looks a little bit messy. Coupon rates, so different kind of interest rates. So the coupon rate is the one that is printed on here, and that's just giving you the relationship between the face value and the coupons. So here it's too small printed, but this is basically $140 is printed on all these little coupons for different times. And that means the coupon rate is 14%, but that doesn't mean that the yield to maturity is 14%, because that depends upon the price. Or say it's slightly different. Let's just imagine in the bank for this time here, let's say these are 10 years, I'm pretty sure these are 10 coupons, right, and the face value. So in 10 years' time, you get $1,000 back. In between, you get $140 all the time. And in the bank, you could earn 10%. And here comes the intuition. This thing here, would you rather invest $1,000 in this bond, or would you rather put $1,000 in the bank? It looks better in the bond. Now imagine it's a financial market. Everybody wants to buy bonds. Nobody wants to put their money in the bank. If everybody wants to buy something, what happens to the price? It starts creeping up. And now let's think about it. How far, not the number, but in principle, how far is the price going up? Because you earn 14% if you pay $1,000. If you pay $1,010, do you still earn 14%? The coupon rate is 14%, but your yield to maturity, if you pay more for something, but you still get $140, $140 to the 1,000 is 14%. $140 to $1,010 is more or less than 14%. Less. So your yield to maturity starts coming down. The higher the bond price, the lower the yield to maturity becomes. So as long as you get more than 10%, everybody keeps on buying bonds. So the bond price goes up and 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 up till it is finally $1,245.78. And if you buy that bond at that price, what is your yield to maturity now? 10%, right? So you kind of earn 10% over 5 years' time by getting all these different cash flows. That's the meaning of yield to maturity. And that's the reason why yield to maturity and bond price are very strongly related with each other, right? And that's the reason why often called the yield to maturity is often called the market interest rate, or the market rates change to, right? So it's all interchangeable. And that's the reason why, yes, the coupons are important, but the coupon rate, not really that important, right? What's important is the yield to maturity. Good, your turn. Again, use that Excel sheet and play around with it a bit, right? Type in 70 cents and do me a favor, before you press enter, think. If you reduce the coupon, what will happen to the value of the bond? I think everybody can say that straight away. If the coupons are lower, would you pay more or less for the bond? Less. If you get less money, you're willing to pay less money for it. But the question is how much? And get a bit of a feeling for it, what's happening if you do all these different things. 815. Other people have that number too? Okay, let's move on to the next one. What would happen to the price of the bond if the coupons were only 100? And that's a kind of an interesting one. So number one, what did you figure out? If the price of if the coupons are 100, Face value 1,000. So that's the interesting part here. If the yield to maturity and the coupon rate, so basically the percent coupon to the face value, if these two are identical, then the bond is just as attractive as the bank account, you might say. And that's the reason why the bond price is exactly its face value. So that's a special number. So if the coupon rate is the same as the yield to maturity in the market, that's the only time when the bonds are sold at face value. Otherwise, the price is either higher or lower, and we call that also above and below par. The coupon's the same, 140, but we're changing the discount rate. Basically means we're changing the yield. So to get your intuition, that basically means we change how much interest we could earn somewhere else. So beforehand, I think we said it was 10% in the bank. Now we say the bank is offering us 14%. Beforehand, we cranked up the bond price so much, 1,200, that the yield became 10%. Now, in order to get a higher yield, we need a lower bond price. So we need to get some more capital gains in that sense again. So what else do we have? What would happen to the price of the bond if 140, but the discount rate is changed to 10%? That's kind of the very first one that we had. Let's see, the yield is coming down, and you can see already the notion here, what's happening. If the yield is coming down, what's happening to the bond price? Goes up, right? So yield and bond price, always the opposite direction. And I know students that didn't have that before, and it takes a while. There's a good logic behind it, because the bond price is how much money you have to pay to get that piece of paper. And the more you pay for the piece of paper, the less your percentage return. So, and the percentage return is the yield. So the lower the yield, the higher the bond price. And the higher the yield, the lower the bond price. And that's something really important that we need for the whole rest of the semester. That's the reason why I do it so much. Sol is basically a bond that runs forever. So there's no final maturity date on it, there's just coupons. But that has a certain value too. It's not infinite value. The value has something to do, again, with the yield. So we can calculate it like it's written here, but we don't do much with console, so I'd rather save the time and jump straight ahead. 0 coupon bonds, they are kind of the easiest to calculate, so in that case you can calculate it by hand. You don't necessarily need a computer for it. I always think it's very easy to imagine a 0 coupon bond. It's the same as a bond with coupons, just that you rip off all the coupons. And in fact, you can make your own 0 coupon bond. So you've got a coupon bond over there. What you could do, just give you so what you could do is you could rip them all off, the coupons, and just sell that piece of paper here and keep the coupons yourself. So that's one of the financial innovations, so you can sell them separately. And then you have 0, no coupons. And we can evaluate it like this. I like to do lots of 0 coupon bonds because they're the easiest to calculate. So in this case here, we have face value. We get $1,000 back in 10 years' time. And if the yield in the market currently is 10%, this one would be trading right now at 385 and something. Again, test question. If I increase the yield, let's say to 11%, what must happen to the price? Decrease, exactly. So if I invest less money now at a lower price, my percentage return is going to go up. So what I want you to do is just go for the intuition. Looking at the Australian bonds, 2-year bonds, 5-year bonds, 10-year bonds, look at the yields, look at the coupons, and without calculating, just think, should these bonds sell higher than $100, so above the face value, above par, or below par? So what do we have here? Global government bonds. So it's basically these kinds of things. And it says coupons. So they've got coupons attached to them, and it sets a percentage. That's just the coupon rate. So just imagine it's a $100 face value here, and then these are the coupons in dollar terms. That's the easiest way. We talk about Australia, and we talk about maturities, 2 years, 5 years, 10 years. This one is the yield to maturity, and let's see what we've got the latest. So up, down here just means if they went up or down. So this one, the 2-year one, has a yield of 1.77. So this is how much you actually earn on that bond. But the coupon is 3.25. So now the question is, will this bond be sold over $100 or under $100? And the way I always would do it, the intuition is the bank account pays you 177%, the bond pays you $3.20. Now what's more attractive, bond or bank account? Bond. That means lots of people want to buy the bond. What's happening to the price of the bond? Goes up, and it goes up until finally your percentage return is exactly 177. Right? So this bond is sold above par. The price should be over 100. Let's check the next one. The yield in the market is 2.2, 2.3. The coupon is 5.75. Which is more attractive? The theoretical bank account or the bond? Bond, everybody's buying the bond price goes up until finally the rate of return on the bond or the yield to maturity on the bond is exactly 2.298. Good, same idea for the 10-year one. So basically compare always the coupon rate with the yields. So again here the coupon rate is high, means the bond is very attractive. So the price must go up until finally the return that you're getting, the yield to maturity, is 2.77. And you can see these yields change all the time too. The price of the bond always runs opposite to its yield. Very, very important. And understand why as well.